Hello and welcome to Bloomberg New Economy Forum, Embracing Instability. I'm Eric Schatzker. These are troubling times. After 75 years of relative stability, the Pax Americana, when the U.S. dominated the global economy, we live in an increasingly multipolar and fragile world. Multiple countries are battling for influence in trade, in technology, and for territory. Globalization is receding, authoritarianism and imperialism are ascending. CEOs, financial titans, and heads of state are speaking out about the dangers of geopolitics. Against this backdrop, we brought 450 leaders from across the globe back to Singapore for the Bloomberg New Economy Forum. Our goal? To bridge the divide between East and West and the divide between the global North and the global South. The discussions here ranged widely, covering the testy U.S.-China relationship, the risks of widening wars in both the Middle East and Eastern Europe, and the choices and sacrifices we'll need to make to save the planet from climate change. Let's begin with a question that will determine the fate of the world, whether the U.S. and China can de-escalate. Chinese Vice President Han Zheng opened the New Economy Forum and offered his perspective on the economy, on trade, and on dialogue with the U.S.
Changes unseen in a century are unfolding at a faster pace across the world. Global economic recovery lacks momentum. Geopolitical tensions are compounded with the evolving economic landscape. Crises of food, energy, and debt are emerging. Having said that, the deepening of the new round of technological and industrial transformation has brought new opportunities for sustainable economic growth. Humankind is a community with a shared future, and a win-win cooperation is the sure way to success in doing great things that benefit all. China is ready to work with other countries to seize the development opportunities of our times, jointly address risks and challenges, and create a better future for mankind. Unilateralism and protectionism lead nowhere. The issue of security cannot be overstretched. Decoupling, severing industry and supply chains, and the so-called de-risking will all only divide the global economy into many isolated islands. We need to follow the laws of economics, support multilateralism, promote the free flow of production factors in the global market, and build industrial and supply chains that are convenient, efficient, and secure. Addressing global challenges requires cooperation and joint efforts of all countries. You all follow China-US relations closely. President Xi Jinping has stressed on many occasions that whether China and the United States can find the right way to get along bears on the future of humanity. The world is big enough for the two countries to develop themselves and prosper together.
Pragmatism is surfacing. We heard it from the Vice President today. A call for collaboration and coexistence between the world's two economic superpower and geopolitical powers as well. We in Saudi Arabia have traditionally had a very strong relationship with the U.S. going back to the creation of the third Saudi state in the 1930s, and of course that relationship has gotten from strength to strength. China is our biggest trading partner, biggest importer of Saudi exports, whether it's energy, chemicals, and other goods, and at the same time they are our biggest exporter of industrial goods, and that relationship is set to continue to strengthen. And we hope we, like Singapore, can play a role in promoting dialogue and cooperation between these two countries.
There's a lot there that we will get into, but Minister Balakrishnan, on the state of the world right now in US-China relations.
With the US and China, I differentiate between climate and weather. Right now, I think the weather is a bit sunnier. They're preparing for the APEC meeting, and we all hope the President Xi and President Biden will have a good meeting. So the weather is improved. But I think the climate, the relationship between the United States and China is not in such a happy place.
The climate generally is getting worse between the US and China. Again, I think people would say it was better when you were around. Is there any sign of things getting better, or are they just going to get worse for a while and then maybe stabilize?
You know, part of the reason it was, somewhat more positive when I was there, and we had a very regular set of meetings, is because Hu Jintao was a Chinese leader who decided he would not stay for life. He would fulfill his term. He would follow the guidance of the Chinese Communist Party. There would be a transition, a new group of leaders, some holdovers, but, other new faces would be in power. And so there could be a constant renewing of both the Chinese government and through that, the American relationship. Once Xi Jinping decided to stay in office for life, that creates a lot of, challenges within their own system. And I think we're seeing some of that with the removal of top officials, some of the economic problems in the Chinese economy. But it also creates a kind of chilling effect in terms of relations. I mean, how do you deal with somebody who's not going to be held accountable? Their system of accountability was certainly different from ours, but it existed. And now it doesn't. And so part of what I hope will come out of this meeting is an attitude by President Xi that, he wants to get back to some kind of regular order, that he sees it in China's interest to really dig in with President Biden, develop a platform for discussions, for problem solving, look for ways to cooperate on whether it's, climate change or other matters that may be of mutual interest to us, really sending that signal. I think he will find a receptive partner with President Biden if that's available.
Coming up, Ken Griffin, the founder and CEO of Citadel. This is Bloomberg. Welcome back to Bloomberg New Economy Forum, Embracing Instability. I'm Eric Schatzker. On day 2 of the forum, I spoke with Citadel founder and CEO Ken Griffin. As you're about to see, Ken is full of conviction on everything from interest rates and inflation to the criminal prosecutions of former President Donald Trump.
Regretfully, the peace dividend is clearly at the end of the road. No matter what one may dream to be reality is there's 2 wars in the world right here, right now, one of which is in Europe. So there's no doubt that the NATO countries are going to have to increase defense budgets over the years ahead. That's going to come at a point in time where governments around the world are already struggling with the sizes of their deficits. And then when it comes to globalization, we're in Singapore. We are at one of the global nexus in the world of trade, of finance. Many of us in this room have been tremendous beneficiaries of globalization, and it hasn't been great for everybody, to be clear. But for the world as a whole, it's pulled 1 billion people out of poverty. But now we're talking about deglobalization. We're talking about re-architecting supply chains. And some of this is rooted in the behavior that we saw in the pandemic. We saw countries hoarding personal safety equipment. We saw the tension around the distribution of vaccines around the world. Countries are much more sensitive to what do we want to have created domestically so that we're not reliant upon global trade. And then take that into the general geopolitical trends right here, right now. The war in the Ukraine has resulted in Europe losing access to natural gas from Russia for all intents and purposes. Europe struggling to deal with how does it maintain its economy having lost its cheap source of energy. So there's many trends at play right now that are pushing us towards deglobalization. And with that is almost certainly a trend towards higher baseline inflation.
Over what period?
It could be for decades.
And the implications of higher inflation might be obvious to some, but I think we'd all like to hear it from Ken Griffin.
Well, it depends on where this baseline effect lands. If we're looking at a 2 or 3% baseline effect, in some sense, the central bank will have a much easier job in the United States. The struggle over the last 20 years has actually been to hit a 2% target. And there's a variety of reasons that you want a low level of background inflation. It helps to lubricate the wheels of commerce. And that number the Fed has committed to as being 2%, they're going to fight pretty hard to keep that as the target for a litany of good reasons. But it also means that we're likely to see higher real rates, and we're likely to see higher nominal rates, and that will have a real implication on the cost of funding our enormous deficit. The U.S. has $33 trillion of debt outstanding. We didn't plan for an era with higher nominal and higher real rates when we went on the spending spree that created a $33 trillion deficit.
I would say inflation is still, to me, the single biggest risk, certainly to economic growth, to purchasing power, to the deployment of capital. And then if you think about how perverse inflation is for those who are less well off, that has a very negative effect on prosperity, lifting people up out of poverty, or even those in the lower middle class that are trying to rise beyond the lower middle class. It's just very perverse for that category, which is in essence what all of us are trying to do in terms of driving economic growth to lift more people, into the system. So I think inflation is far and away the biggest concern. And I think the geopolitics that are now overlaid in a much more profound way, in many ways you could say that the peace dividend we've had for the better part of 25 or 30 years is kind of over. And we're entering, unfortunately, perhaps a new era with more geopolitical tension, more war, more challenge that I think is going to make it even more complicated to create more economic growth.
Jenny, inflation and that journey to 2% for the Fed, I mean, the markets were quick to conclude that the Fed was done and then change its mind. Was the Fed right in standing pat?
I do think the Fed was right to stand pat. I think that, though, the journey to 2% is going to be a lot more challenging. And I would just add on, so John, really leave a couple things for the rest of us to talk about on the rest, okay?
He says he's paid to worry about everything.
But so completely agree with all the points that John made. I would just say the other challenge that I don't think gets enough, and you're starting to hear about it more, is, even if the Fed is able to slow the economy such that it gets inflation lower, there is this issue of just supply and demand for U.S. treasuries and U.S. debt. I mean, the reality is the U.S. has gone from $7 trillion or $9 trillion in 2007, $31 trillion. We're going to add $2 trillion more. You have to have buyers. Now, there'll be buyers. The question is, at what price will there be buyers? And then, one, how much does that crowd out other investment opportunities? And two, does that mean higher for longer, which I tend to feel like that is an issue. So I think along with the inflation, even if the Fed does their job in trying to slow it down, they don't control U.S. spending, and that debt, I think, is adding a challenge.
Chowkiat?
You ask risk, the other side of risk is return. So perhaps, if you sort of wear more of that cap, Jenny talked about, treasury bond or cash yielding more. That's a positive thing for investors. In fact, I would say, look at U.S. tips, right? U.S. 10-year tips is yielding a real yield of 2.5%. We haven't seen that for a long time. It was negative. That means you actually get inflation-protected return guaranteed, right? Because I believe the U.S. government is rock solid For 10 years, you clip, 2.5% above inflation. That's very attractive, I would say, and that's actually great competition for a lot of other asset classes, right? If you were to take additional risk, you have to expect a return higher than that level of 2.5 real. So that's one, way to look at it. Generally, asset use going higher should be good for long-term return.
A risky environment and such an environment is a great environment for healthcare. So you should be thriving.
I think that we're at a moment where we're kind of being increasingly suffering from a series of pandemics. I come from a world where we worked on a pandemic at Moderna, and we think that a pandemic means a disease that afflicts the planet. But actually, literally, a pandemic means anything that afflicts all people on the world, essentially in a negative way. And so think about what's happened. You have a pandemic, a health pandemic, that led to a financial pandemic, a supply chain pandemic, a geopolitical pandemic, a war pandemic, a misinformation pandemic, and then you have the climate pandemic waiting to get its chance to really have a big impact. And so what has that done to our general notion of economic equilibrium? Well, it's made it laughable, I think. And in nature, these things happen. It's called punctuated equilibrium. And I think we should really start thinking about, and I heard a little bit this morning, when will it go back? The people who wanted things to go back are the incumbents. Insurgents want it to go forward, because in the back, they really don't have a role to play because they're dominated. And so I think what you're going to see in this environment is the appearance of a different and new equilibrium state. It's very scary because obviously investors value predictable, profitable growth. There is no predictable, there's hardly any profitable, and there's hardly any growth.
I personally think that I'm more in the camp of high for longer than higher for longer. But I don't see how we can bring back inflation at target. Everybody focuses very much on the big drop, but the truth of the matter is that inflation is well above target rates across the globe, and is much stickier than we think. So I don't see how you can bring back inflation without creating an economic downturn. We start to see it now, clearly in Europe, and most possibly also in the US soon. So
if you have interest rates high for longer, and there's an economic downturn, what breaks? Is it companies defaulting? Is it commercial real estate? Or are there other pockets in the market that you worry about?
Look, I would say that companies, the vast majority of the companies are well placed in terms of capital position. I'm not so concerned at this stage about the private sector. There are, and if you want to look at major events, right, black swan events or things that can really go wrong, history tells us that they usually come from government or real estate. So I think that while we look at the private sector, I think that the reality is that the most fragile part of the equation, if I look at the real estate, commercial real estate markets across the world, the post-COVID positive momentum was very short. So, and now the reality is that we see that COVID has changed the way people work, people use offices, and we see it as we speak that that one has to be watched carefully.
Coming up, John Kerry, the U.S. Special Presidential Envoy for Climate. This is Bloomberg. Welcome back to Singapore and Bloomberg New Economy Forum, Embracing Instability. I'm Eric Schatzker. Former U.S. Secretary of State John Kerry delivered a riveting close to this year's forum, setting priorities and expectations for the important work that needs to be done at COP28 in Dubai.
You ask, what is it that's in the way? The imperative of status quo, the way money works, the numbers of people who have pressured some of the oil and gas companies because they weren't doing as well as the ones that weren't doing stuff on the climate. Look at the pressure, a bunch of asset owners and managers in New York and elsewhere in the world have been under to make more money. So put it down to greed, G-R-E-E-D, greed. People do not want to transition. People are waiting. People say, oh, it's in the future. It's not in the future.
It's the biggest existential
It's now.
crisis facing us now.
And
but
it
getting
is
that
being
message,
delayed by personal and by unwillingness of people to grab the bull by the horns and do what you need to do here.
In that context, then, what's a successful COP28 in your mind?
Well, I think doing the things that are mandatory, obviously. We have a mandatory report on adaptation. I think we will increase the level of funding for adaptation, but we will balance it with mitigation. We will have major step-ups, I think, in mitigation effort, and they will come, some of them, from these sidebar things, like the shipping challenge and the agriculture mission and the First Movers Coalition and so forth. But those aren't substitutes for the fundamental need to have NDCs of countries that actually drive their country's policy to keeping 1.5 degrees alive.
The science is so clear. We're 1,200 islands in the middle of the Indian Ocean. Most of our islands are just about 1 meter above sea level. And we are observing sea level rise of 3 to 4 millimeters per year. We are seeing most of our islands are eroding at an alarming rate. Most of our islands are getting flooded during the rainy season, more than we used to see. And the biggest impact that I have seen, even in my own life, is the slow death of our coral reefs, which is the source of income for us, which is the source of protection for us as well. So impacts of climate change is an everyday reality for us.
My view is for this climate transition to happen, the big thing we need is solutions at an affordable price. The US is playing a big role, I think, at the moment. Out of the money being invested, a lot of it is going to electric vehicles. So they're giving us $7,500 credit per vehicle, and the estimate is that passenger vehicles are going to go up by 13 times by 2030. This is IEA versus 3 times without the IRA. That's helping. A big one is on hydrogen. We really need a form of firming for renewable energy, and the estimate is there'll be 5.5 million tonnes of green hydrogen by 2030, but we need to get that price down to, say, $2 a kilogram, and the incentives in the US will probably crack the code for the world, and as Mark says, those technologies can get rolled out.
Who is going to accelerate, pull through a combination of industrial policy, our topic, but corporate action, corporate leaders, and there's a series of initiatives around that, but they're not yet getting the traction they need at scale. And then, GFANs, the members, whether it's Macquarie, Brookfield, HSBC, whoever, provides the financing against that really accelerates. And that's what we need to do, and that's part of the opportunity of getting everyone around the table at COP. And I think that's, so we should look for something and push for something on that front.
But you're hopeful about COP? That we get something concrete?
I think all the right people are there, and the right issues have been put on the table. So, yes, I mean, in that regard, we should, you never take things for granted, but we should force the issue.
That's all from Bloomberg New Economy Forum, Embracing Instability. You can find the complete interviews and more content from the forum at Bloomberg.com and on the Bloomberg Terminal. I'm Eric Schatzker. This is Bloomberg.